In today's video, I'm going to be sharing 5 things that you must check out for before entering a trade. Now, checking out these things could actually get you into a trap where 90% of traders fall into. You have opened up a trade and all of a sudden it's going against you immediately, or you actually opened up your trade without following the right setup and not knowing the exit points. Now, without any further ado, let's dive straight into it. Now, the first thing to always watch out for is the economic events. Now, I wouldn't mind if you use technical or fundamental analysis in your trading. It's so important to check out for any economic events before entering any trade or before your analysis, literally. Now, to me, the first thing that I do is open up my economic calendar, check out for any high impact news events, check out the time they are happening, and look at the pairs that I could be trading so I don't trade that day. So I'm actually going to give you a detailed look into the economic calendar so you can actually know how to even use it. Now, some of the economic calendars that you can have on your phone can be investing.com, Forex Factory, and others, but I would recommend investing.com. So get your calendar, look at the high impact news events, and know exactly what time they are happening. Now, to me, the style of trading, I don't trade news. So every time I see there's a high impact news event, I'm either not going to trade or I'll just exit the trades that I was actually in. So here's just a look on how you can actually be able to use investing.com. So initially, this is how it looks like. So it has all the events that happened yesterday, today, tomorrow, and then this week. So what we focus on the most is today. And before you make any changes, it has all the news events that may be high impact and then some that aren't high impact. So the easiest way to actually filter out the high impact news events, because they're the ones we need to watch out for, is click on the funnel just somewhere up over there and then check down set importance, low, medium, high. So we only need high impact news events. So we are going to uncheck the rest and then leave the tick to the high impact news events. And boom, this is how we look like. So just like today at 5 a.m. in the morning, here we had an event about the New Zealand dollar. Meaning if you were trading the New Zealand dollar, you'd probably not trade. So we are just going to give it a try and look at the charts so we can see how the New Zealand dollar performed at that point. So let's check out for the New Zealand dollar. So I'm currently on the H1 and we can see a very big candlestick. So I'll be sharing my screen recording, but you guys can also have a look at such a big candlestick right over here. So this happened at 5 a.m. in the morning right here, just because we had a news event on the New Zealand dollar. So meaning in such an event, if you had actually opened up buys because your technical analysis stated that it was going to be a buy, you would get stopped out. Now, the easiest way to go about this is you are either going to be trading fundamental analysis, have a trading strategy that is actually going to match the news events. You can actually open up a buy stop and a sell stop just on both sides. So the moment one is triggered, the other one is going to be closed and you can actually ride a big move. But I would recommend that always check out for any high impact news events before opening up any trades. Now, this video is sponsored by FX, literally one of the best brokers, and I'm going to put the link somewhere down in the description below. Open up a trading account and let's kill this big together. Now, the next thing that you must watch out for is the market a trending or a ranging market. Now, I've seen most traders fall for this trap where they open up a trade just because they saw some sort of a short-term trade, yet in actual sense it was a consolidating or a sideways market. So it's also important that you understand if it's an uptrend or a downtrend. So I'm going to give you a look on my phone so you can actually see what a trending market looks like and what a ranging market looks like and how you can actually determine those. So going back to my phone, looking at NZD USD, just like what we were seeing currently, you can see that this is a very great series of a downtrend. We have a very big push to the downside. There we go. And we could actually look out for an uptrend. Either way, this is a downtrend right over here. We would have a beautiful downtrend right over here. And then we have a very great uptrend here. So like we said, in an uptrend, it's a very good series of higher highs and higher lows to the upside, meaning the market is trending to the upside. In such a case, you would basically be looking for buys. Now, I wouldn't care whether you're scalping or doing this and this. All I know is when it's an uptrend, just look out for those buys because you are moving with a general market trend. Now, identifying the trend can easily be done by you just looking at the charts, understanding what the overall trend is. Just like what we did right over here I could just look through and understand that it's an uptrend. So the other way to establish the trend of the market is by using trend indicators. So get your indicators section such as for moving average and set that moving average to a period of 200. So that's one of the easiest ways to establish the overall trend. When the price is above the 200 moving average, it's a very good uptrend, and when the price is down the moving average, it's a downtrend. Either way, if the moving average is just crossing through the candlesticks, it's a ranging market. So be sure you establish if it's a trending or a ranging market. Now the other thing that you should always look out for is correlation. Now correlation is you being able to compare either 2 or 3 pairs, and this is so brief. So some pairs might have a positive correlation and then others are going to have a negative correlation. Two currency pairs having a positive correlation means they move in the same direction. So an example would be GBP/USD and EUR/USD. We could actually compare them on the charts and see how it actually happens. Alright, so we are going to check out for EUR/USD, EUR/USD, and then GBP/USD. So EUR/USD and GBP/USD have a positive correlation, meaning if EUR/USD is in a downtrend, more often enough GBP/USD is also in a downtrend. So it's always so important that you check out for those pairs that either have a positive correlation or a negative correlation. So giving you a look around this, so this is EUR/USD on the H1, and without any changes we can also check out for GBP/USD. So EUR/USD literally this way, initially it just came on a very big push to the downside and we are sort of bouncing off now. But looking at GBP/USD right over here, it's the same thing. So we were also in a big downtrend, and then right now we are sort of pushing to the upside. So always look out for pairs that do have a positive and negative correlation. So like I said, an example would be EUR/USD and GBP/USD. You can also check out for EUR/USD and USD/CHF. Now those two have a negative correlation. If EUR/USD is buying, USD/CHF is more often enough selling. So you can easily do that by establishing all those pairs, having them written down, and checking out for those ones that you might be interested in trading. Now the next thing that we can always look out for is your entry and exit points. Now I've seen most traders do the same mistake over and over again, entering a trade without actually understanding when to exit. For the entry point, it might be easy because most trading strategies might actually have when to enter a trade, but you having to understand when to exit is going to save you a lot of trouble, you failing to close losing trades or failing to close winning trades. Now for any trading strategy, it must have the to understand when to enter trade and when to actually exit. So always be sure that before you enter trade, you have your entry and exit points established. Now going to the last and fifth point, always check out for your risk and reward ratio. Now don't be this type of a trader who is going to open up a trade without a stop loss. Understand where you have to place your stop loss and your take profit before entering any trade. Now this may not be standard that every trade I'll always use a stop loss of 25 pips or 30 pips. Not actually, because some pairs might change and your analysis might actually change, but understanding what to place a stop loss before entering a trade is going to always be a very great idea, because you wouldn't fall for the same trap of again having to adjust your stop loss or having to adjust your take profit because you're just distorted because a trade went against you, because you made money and you want to make more and all that. So it's always so important that you have your risk to your reward ratio established before any trade. Now those are some of the 5 most important things that every trader must always check out for before entering a trade. Now if you watch this far, consider smashing the subscribe button. I mean, why shouldn't we hit 100k? We look at hitting such a big target and you can be part of this big movement. So I'll see you in the next video. I'm out.